don't know what will happen in year
3. Okay.
I mean, that could be the challenge in determining what that number should be.
See, if we look at IAS 36, what's the difference between IAS 36 and IFRS 9? In IAS 36, the concept is how we impair fixed assets. So when you buy fixed assets, do you expect them to get impaired? No. Is it part of the process? No. So when you buy fixed assets, impairment is an anomaly. It's not normal. So the argument is, let's not book an impairment until it happens. Because impairment is not supposed to happen. Right? Now, if you give people a loan, do you expect impairment? Of course you do. Not on aggregate. If you give 1,000 loans, you expect statistically some loans to go bad, most loans to go good. Overall, you make a huge profit and get your bonus, right? That's what you expect. So the difference is losses are part of the normal process of lending. They're not part of the normal process of buying fixed assets. Agreed? So conceptually, there's an argument that doesn't it make sense to use the incurred loss model for fixed assets, but for financial assets, for loans, doesn't it make sense to use the expected loss model? That's an argument, right? Now, when I ask which one's better, you all say the second one, except you, right? Maybe. Is that correct? Yep. You sure? Yes. Now, let me ask you a question. So if I'm going to come to your office and I'm going to discuss the bad debt provision, all right? Would you be optimistic or pessimistic? Now let's just go back in history. George Bush is president. It's 2007. So in 2007, when I come to your office to discuss the bad debt provision, would you be negative or positive? George Bush was president. Positive. 2007. It was a wonderful year. I would come, you would say, we don't need a provision. In fact, have you seen the movie The Big Short? In the movie The Big Short, the analyst from Moody's and all these analysts said, housing prices in America never go down. If you loan money, if someone has a house as collateral, you cannot lose money. That's what they said. Right? These are what the premier top agencies said. They were full of nonsense, right? Yes. Now, if I come back to your office and it's December 31st, 2008, what would you say? You were depressed. Yes. Obama was president. We went from Republican to Democrat, right? Taxes are going to go up. The economy was a disaster. Banks. This probably never happened in Pakistan, but interest rates became negative. Not zero, negative. Can you imagine negative interest rates? Not positive, negative. So you put money in the bank and you get a negative return. Banks wouldn't lend money to each other. They were too scared. I remember that year very well. I applied for a loan to develop some of my property. And I came back from my vacation in August. I go into the bank manager, as a Greek bank. And if you ever work with Greeks, they talk with their hands like this. So I go to the president of the bank in Romania. It was a Greek bank. I paid documentation fees. I paid for the valuation. I did all the paperwork that these guys make you do, right? They give you a headache. Did all their paperwork. I go into the bank. I'm thinking I'm going in to do the formalities. I sit down in the president's office of the bank, and he goes to me, Mike, no more loans. And I go, what are you talking about? You're a bank? I give you what you want. He goes, market finished. No loans. No loans. And I'm thinking, oh my gosh, these Greek people are really weird. Because I didn't know what actually happened. This was in August. So it wasn't really mainstream news in August, July, August. It became mainstream a little bit later. Because the market didn't really collapse in August. It collapsed a little bit later, I think. So I'm in August. I just came back from my summer vacation. The stock market was fine. And I'm thinking, oh my God, this guy's loony. I mean, and I paid all this money. These bankers took all my money, all these stupid fees. And they said, no loan. I was angry. Thank God my loan was denied, or I'd have been bankrupt. So the point is, what would happen is, in good years, you have no provision because you're stupidly optimistic. In bad years, you're excessively pessimistic. So what do? You make big provisions. So if you think about this, what you should be doing is in good years making provisions for the bad times. But you're going to do the opposite. So in good years you make a small provision, and in bad years you make a huge provision, so you make a situation bad to worse. And then, of course, a lot of those provisions were wrong, right? Remember the stock market, I don't know if you follow the U.S. stock market, but the U.S. stock market went down to 7,300. Now it's at 28,000. So the market went down so low, it overreacted. It overreacted. So what a lot of people would say, probably what you were thinking, is the problem if we go to an expected loss model is how do you do your expectations? And those expectations might introduce more volatility into how we determine our profit. So what happened is the Americans, the FASB and the ISB, had a very different perspective. The Americans were concerned about showing the true presentation as the number one objective. The ISB was a little bit more concerned, I think because realistically they have a wide range of markets from Africa to Asia where they don't have always the same skill set. And I think practically the ISB was saying, well, we don't want a situation where there's a lot of manipulation. So we came up with two completely different approaches. The Americans say full lifetime losses, and the ISB said, hold on, we're going to put the brakes on losses that are lifetime. We're going to have these different categories and these limitations. So sometimes what we're going to do is let you to take a small bit of the loss, so if it's really wrong, it's not going to be a major mess. And other times, we'll take the entire loss. So the IFRS people came up with this academic approach where we have stage 1, stage 2, stage 3, and we take a year to document these stages. And then we have to figure out how to get them in the system. And then we have to come up with this model to book losses differently if it's stage 1 or stage 2. And these losses that we're going to do in IFRS have nothing to do with Basel. It's a point in time where Basel is the framework that banks use for the regulator, is that through the cycle. So we have this completely different model. And when banks had to put this together, they had to spend a year, 2 years, 3 years. They had not just one Big Four to help them. Some of the banks had 2 Big Fours and a consultant here and a consultant there, and the consultants all had a different view. So we made it to a big mess. So I bet if we go 20 years from now and I come back, we'll be saying there's a new model. It's called the incurred loss model. Because in the last 20 years we had all these frauds. And to stop all these frauds, we have a much better approach. You can only book a loss when it's known. No more frauds. Watch. This model is highly subjective. It's a headache. I'm not an expert in the actual model part, because those are people that are good at data analytics. It's very, very data-driven. Very data-driven. And what the banks I work with usually do is the data people get their number, and then management has a number on top of it. So the data guy can justify a number. Management sometimes makes another adjustment, which is from the error. You put those together, and there's your adjustment. So the auditors go to the data people for one of the numbers, and management for the other number, which is a bit from the space. So I think which one is better is not such a straightforward question. I think it's a complicated question. I'm not sure it's going to be better because some of these models that I've seen developed are very, very messy. And you just look at them and you say, oh my gosh, we need to have a degree in magic. We used to be accountants, now we have to be magicians, pull a number out of a hat. And the problem is, what number do you want? There's always a bias. There's always a bias. And I also don't like the fact that if you have to have two different audit firms advise you, and they both have a different opinion, something is wrong. You know, at the end of the day, the auditors, in my view, overstep their role, because their role is to express an opinion. Too often, the auditors tell us what to do, which I think is wrong. You agree with me there? That's not, but they do that, especially in the U.S. and a lot of the very developed markets. The auditors tell you what to do. And that's not their job. Their job is supposed to be to give an opinion. Now, what was interesting is that the U.S., okay, so what we have in IFRS, and I'll explain it in more detail later, is a limitation where we only book the losses that relate to the next 1 year. So there was a concern that if we used the incurred loss model under under U.S., not U.S. GAAP, but under how it was applied in the U.S. There was a concern that this number would be bigger than the expected loss model in IFRS. So how on earth could the incurred model be bigger than the expected model? You're the banking guy, right?
It can be. I can tell you about Pakistan. So we came up with a hybrid approach where our regulator intervened and has combined both of them. So we have to provide for the expected credit loss. That could be stage 1 plus stage 2. And then we have the stage 3 as well, which is actually the incurred loss model. So we are currently providing provision for expected credit loss for stage 1 and stage 2, and then the incurred loss model for stage 3 as well. Based on the regulatory.
And do you take the whole amount to P&L, or does something go to OCI?
Yeah.
All to P&L?
Yeah, P&L.
Because in Africa, what they did in some countries is they took the ECL before IFRS 9. Okay, before IFRS 9, some regulators to OCI.
That's the first time adoption.
No, and I get that, but I mean, okay.
So it's a combined approach. I mean, you can say now.
But stage 3, incurred and expected are the same.
Yeah, it is the same.
So it's stage 3, expected and incurred is the same.
The only difference was what we did is for stage 3 there are regulatory percentages that defined. We didn't change that. We didn't change the LGD for that.
Okay.
So we just took the regulatory.
Got it.
Actually, after adoption of IFRS 9, we are providing some extra amount, which is coming out of all the models and the calculations that we are doing for the estimation of the stage 1 and the stage 2. And stage 3, which we defined and is not in IFRS. So
It's set by central bank.
yes, central bank. So that's incurred loss, which we have been providing for the last.
But I would argue that your stage 3, incurred is the same as expected because,
We're not calculating it. It's already.
yeah, but I mean, expected means the loss is going to happen later. In stage 3, the loss has happened. So by definition, stage 3 is expected, incurred is the same thing. Expected only relates to stage 1 and 2.
Based on aging rather than we can say
Yeah.
any modeling, but
It's based on central bank.
Yep.
Okay, but my point here is a little bit different. In the United States, there was an issue when they heard about the IFRS approach, because the Americans were concerned that the incurred loss number would be big as applied in the U.S., and the expected loss number would be small. So if the incurred loss was 100, the Americans were worried that the expected loss would be smaller. Now, normally the expected loss should be bigger, right? So my question is, how would you expect the incurred loss to be bigger than the IFRS model? Now, it's an advanced question. You might have no idea. I'll have to explain it. Because the issue is, when is a loss incurred? Well, okay, so I've loaned money to all of you. Now, it's clear that the loss is incurred when you're late, right? But before you're late on a loan, what happens? Let's say you lose your job. What usually happens if you lose your job, you go to your brother. Hey, I got to make a loan payment because I think I'll get another job. And the next month, you go to your sister, and then your uncle. And then eventually, there's no one to go to. So what the Americans have done historically is the U.S. SEC has challenged the bank's models to say there are loans that you have where they're not late, but a loss is incurred, you just don't know about it. So the U.S. regulator challenged the bank's models to say, we expect in your model for a loss estimate for incurred losses that you don't know about. And so therefore, U.S. historically had a higher loss provision than under the international approach where they weren't as aggressive. If you ever work with the U.S. SEC, they're very aggressive on some things. Now, the concern was, if we go to a 12-month loss, that actually you could come up with a model as to how it was applied in the U.S. where the provisions could go down. That was a discussion point they had at the board level. Because the U.S. was forcing banks to book losses that were, quote, incurred but unknown. And globally, we used to book losses when they were incurred with an indicator. They were late. Something happened. So that's why the Americans didn't like the ISB approach. They thought provisions would actually decrease and not increase. And the objective of the expected loss model was to increase provisions. So that was one of the discussion points that was had in the U.S. So I think the conclusion is the expected loss model is trying to address an issue, but at the same time is going to create new problems. Is it a perfect model? Absolutely no. Yes? Because in America, the regulator forced companies to estimate in their portfolio losses that they didn't know about that were incurred. And there was a perception that if they had the 12-month rule, that some of those might come outside